Welcome everyone to another one-to-one mining investment virtual content session. Today I'm delighted to be joined by a fantastic lineup of investors who will be discussing how they've adapted to working through the COVID-19 crisis, potential impacts on portfolio making in the near term, weighing up how companies can continue to attention going forwards. So I'd like to welcome then our esteemed panel of speakers: Vera Ivanova, Investment Director at AMED Funds; David, founder and CEO of Tembo Capital; Verne, Grinstead, Senior Advisor at ANRH. And I'd like to also hand over to our very capable expertise of Charles Bond, who is partner at Gowling, and is going to be taking us through today's discussion. So Charles, I'll hand over to you to lead the way. Thank you.
Thanks, Adam, and welcome to our panelists, and thanks very much for taking time out. I know the people who are watching this video will be really grateful, especially for your insight at this very unique time in the market. I suspect none of us have really seen a market like this before, despite our collective age. So I know that it really does present some disadvantages, but also no doubt there are many opportunities out there, and I guess that's what we're all interested in. So with that in mind, we've put together some questions for you, really just to gauge your feelings. And the first one is really, where do you see the risk and reward in the market at this point in time? I'm conscious that last year, private equity group investment was relatively down compared to the previous year in 2018. There may have been various reasons for that. It may have been that there was quite a lot of fundraising going on by the funds, but the general feeling is now that the funds are have got significant amount of cash behind them. So in theory, you all should be in a good position, being cashed up and ready to make investments on opportunistic investments at this point of time. So I guess the question to all of you is now the right time to grab a bargain? And if so, where do you think those bargains might be? So maybe if, just because of the shape of my screen, I'll start with David first. And maybe David, you can comment on where you think we are in the market and what are those opportunities?
Sure. No, thanks, Charles. Look, I think it is a very unusual time, as you said, and I think more broadly across equity markets have bounced back actually in quite a resilient way, given the amount of central bank and government impetus that's been put in place. I think it's difficult to generalize across the mining markets because obviously gold shares have performed pretty well this year, and the gold price, it looks to be on an upward trajectory. It's doing well. Gold stocks are doing well, partly because of the gold price, partly because of FX sort of currency effects as well, which is helping a number of companies, and low oil prices, which obviously also helps a number of companies. I think there's probably, whilst I am actually very bullish about the gold price at this point, I think there's probably more interesting things for us on a longer term perspective in terms of some of the base metals and other metals at the moment. I think broadly over the next sort of medium term period of time, we would be pretty bullish across the commodity complex. I think we're going to see a lot of stimulus from governments, and whilst I think overall markets are pricing in a sort of V-shaped recovery at the moment, I think in the medium term I would be pretty bullish across most metals at the moment. So I think there are some opportunities around.
And Verne, from your point of view, are you similar bullish? I mean, one of the things I was reading this morning was the drop in consumer demand, for example, is going to have a big impact on copper. So do you see that all the different metals are going to be on an upward trajectory, or is it only a handful?
Well, I'd agree with David regarding gold, and gold certainly is having one of its periodic good moments. Both investors buying the metal as well as gold equities, which could be in an outperform phase, which happens every now and then, in which the Canadians, the Sprots, and the others tend to try and catch those particular waves, and generally have done pretty well out of it. But certainly base metals, China's back on stream, the economy's opened up. Copper, the red metal is broadly of interest, including for EVs and battery storage and the like. And so I think the continuing love affair with copper will continue. Some of the other base metals are a bit more problematic in terms of supply and demand. But nickel has its day from time to time. Lead, zinc, etc., come into and out of focus. But we should also remember fertilizer type products, potash, phosphates, and the like, which are relevant to agriculture and a growing global population. So I would basically agree that right now is not a bad time to be in mining PE. It's surprisingly good, actually, compared to other sectors out there, which are because of COVID on their backs, except for, of course, the big momentum-driven tech fangs and similar stocks, where tech is having a big day in the sun at the moment.
Yeah. Tech, and Vera, from your point of view, I know you look at a lot of African investments, for example. Do you feel that there's a similar trend?
Yes and no. You ask if it's a good time to grab a bargain, and grabbing a bargain it implies acting very quickly and getting something really quickly. And I think typical private equity model assumes at least a few months of due diligence. And given where we are in the market, it's quite unpredictable what's going to happen in the 2-3 months. So we have to almost pretend like nothing is happening and believe in long-term fundamentals of demand and supply, and look at what was hot before COVID, and believe that this will continue. So that goes back again to copper, which both of my colleagues here have discussed already, and the battery metals, of course, will remain to be hot. The World Bank just issued a report saying the demand for the basket will go up 5 times and then until 2030. So these metals will, of course, remain very interesting. But however, again, good assets are never a bargain, and they not the bargain now after COVID. So there's still a lot of people piling up and doing their investigations on very good assets. So they're never cheap and they're never underpriced, unfortunately. So that's one observation. In terms of the only one real newcomer I see after this new reality kicked in is actually iron ore and related commodities such as ferroalloys, and that comes from the fact that there's 12 trillion plus of stimuluses which are coming from every direction, and a lot of it is going to be spent in infrastructure. So I think this is one of the only metals that I can see that might have a systemic shift caused by COVID-19 specifically, and that systemic shift might last longer than short-term V-shaped, reaction. So I am bullish on iron ore, believe it or not.
And what about one of the other metals that I've heard on various other conference calls that people it's having a bit of a resurgence is uranium. Do you think that's just a short-term reaction to the shutdown of the various producers, or is that more of a long-term trend?
Look, it's tough for me to say because we don't have uranium on our target list. In my mind, again, it's probably short-lived. We never invested in uranium due to certain complexities which come with owning an asset, investing, developing, and operating. So it's difficult to comment what for the rest of the market. Uranium is not on our target list.
Okay. Verne, David, do you have a view on uranium?
Well, you know, a couple of years ago, they floated in London this uranium company. What's it called? Yellow something? Yellow Cake?
Yellow Cake. Yeah.
Yellow Cake.
I haven't looked at the price recently, but for a while after, it seemed to perform quite well. There are a couple of US listed uranium companies as well. Amir Adnani is the CEO and founder of one of them. They come and go, but it's not a sector typically which private equity looks at in terms of mining private equity. They tend to look at precious metals, base metals, perhaps you know, potash and fertilizer type minerals. If you look at most of the portfolios, but perhaps one day uranium will have its day in the sun, as it were.
And Vera, you mentioned, you know, that I think it's a very good point about the speed at which private equity can move. Does that mean that if, and it's often not the case, I think, with miners, someone said to, the other day on one of the podcasts that the junior miner community are like cockroaches, you know, they hang around for ages. It's really difficult to get rid of them even in a financial crisis. So is the likelihood of you seeing any distressed assets, for example, that you can move on quickly? You're not seeing anybody in particular distress or where there's a fire sale?
Well, the thing is, I think assets that are distressed now are probably becoming distressed before COVID-19. Mm-hmm. And for reasons other than COVID-19, which is mismanagement, it's not very good assets, you know, like running out of funds anyway, so there's no buffer to weather the storm. So by definition, then you probably wouldn't want to invest in distressed assets now, because there are reasons other than COVID which brought them to this state. So companies that I see that are really, really distressed in this situation, they were in this situation before New Year, for instance.
Right.
I mean, you could imagine some deals that were advanced and had gone through IC at the PE funds, and COVID may have caused some downward ratcheting of the, you know, valuations, and the PE firms might try to take advantage of that, and the sellers may be nervy about the future, given the very significant economic downturn that we're all going to be facing shortly. And so you could imagine some repricing occurring, but as Vera says, you know, the IC process of a private equity firm is to not just be based on price and rapidity. It's like, does this fit our charter? You know, will it generate our returns? Have we professionally and correctly gone through all the DD to result in a final sale and purchase agreement or investment contract?
Yeah. I think that's right. I think the difference between the current events in the market and the period after the credit crunch, I mean, obviously mining company balance sheets are in a much more stable and stronger position now than they were then. And so you're not seeing kind of distressed sale of assets really very much at all at the moment, from what I can see. We have seen a few things which are kind of mid ramp up or, you know, coming into production, which is a difficult time in the life of most mining assets. And it's obviously unfortunate, I think, if companies been halfway through building a project and this has happened now. I think that's a difficult spot. I think where companies are doing feasibility studies and things like that, it's obviously much easier to scale back spending a little bit and do work remotely and add value to things remotely. So I agree with Vera. I don't think we've seen the kind of levels of distress that we have in previous crises.
Yeah, the point you make about feasibility is a good one. I mean, from when you're looking at companies and doing your due diligence at the moment, how are you dealing with the practicalities of that in the current situation? So, mean, you can't do site visits, so it's all desktop analysis at the moment in relation to investments.
Yeah, I can answer. We have a very good example. One of our companies, portfolio companies, is finalizing a PFS, and we cannot get some of the test work which has commenced before the lockdown in South Africa. However, the contractor can write pretty much all of the upfront section of a report, and including doing the financial model and all that comes with that. And now the only thing which is remaining is to slot in the results, which will be available pretty quickly now that the lockdown in South Africa is lifted. So certainly possible, it was possible to front load some of the desktop analysis, which was susceptible to desktop analysis. And then with lockdowns being lifted in some of the jurisdictions, we just sort of finalizing work streams which were supposed to, we cannot be done desktop.
Yeah. I guess moving on a little bit, we're talking about investments, but when you're looking at the life cycle of funds, some of the commentators say that, you know, now you may be 5, 6, 7 years into your original funds from when they started. So as well as looking at investments, are any of you also looking at, you know, the disposal round? Is for other funds out there, is this a time to be disposing of investments?
Well, if I could touch on that, you know, some funds have deal by deal carry exit arrangements. Others, you know, have a European style where it's at the end of the fund life, and so certainly the former, but maybe the latter as well, are always in sell mode. You know, PE firms exist to exit. And so I think there's a constant level of interest in what you can exit at, provided it achieves your target MOIC and IRRs. You know, if you happen to invest pre-IPO and the company IPOs, you know, you're going to exit. Or, you know, if you can achieve your return multiples, or if you can't, you'll bide your time. But it may be that funds that are you know, rear-ended in terms of carry payment, you know, they may be more patient and may time their exits or have more luxury to wait for better markets to exit. Whereas those that are deal by deal, you know, are looking all the time at what can they get when.
Yeah.
I think that's right. I mean, typically funds have different vintages of funds. So, you know, we've exited some investments from our first fund, for example. Toro Gold last year, for example, was sold to Resolute, and so we've been, you know, I think quite active and quite successful on the exits that we've made over the last few years. But as Verne said, you're perennially looking at new things and exiting things as time goes along.
And obviously, if you can get some successful exits and multiples, you know, that helps your case when you go to Fund 2 or Fund 3 or Fund 4. You know, in a sense, you have to have had at least 1 or 2 decent exits to go from Fund 1 to Fund 2 and so on.
Is now an easy time to raise money, or is it? Do you think people will be looking to put more money into funds at the moment?
Well, I'll defer to David on that. He's more live than I am on that front.
Yeah, not. Look, I think it's that period of the market where all the investors are looking at their portfolios and what they can, you know, what their positions are. But I think there are some good opportunities around. So you know, I think it will be possible to raise money in the current market. You know, more. Sorry. Yeah, well, I think everything's going to be slower, isn't it? Yeah. I think project development will be slower. You know, pretty much everything will be slower across the board, really.
Yeah. And
I'd
there anything...
add to that looking at you know, the real asset bucket that the LPs, you know, look at mining and metals versus oil and gas versus agriculture versus timberland. I think there's significant backing off from PE investments related to oil and gas and fossil fuels. And if you look at Preqin's most recent natural resources review, you know, something like 90% of private equity funds raised in the natural resources sector has gone into energy. And so mining in some respects is a niche industry. It's like 3% of the funds raised. So it's quite possible that LPs may, you know, transfer to the mining and metals side some of their firepower and lessen, you know, the oil and gas fracking investments that they made to date.
Yeah, no, I can imagine. I mean, and some of that I guess may go into the renewables industry as well.
Yeah, renewables, although renewables returns, ironically, in the private equity sphere have not been that stunning at all. But a lot of money is looking to go into it. And I'm aware of at least one African targeted PE fund that's raising right now to invest in African renewable energy. And they've got some good cornerstone investors for that, big well-known names. But another theme is indeed ESG/impact investing, which has become pretty big. And, you know, whereas perhaps the old ESG page used to be the third last page in your slide deck, it's now perhaps the third page in your slide deck. And LPs are wanting evidence that that the metals and minerals that you're producing is going into end user applications that could be viewed as, you know, positive impact outcomes. And, you know, it can be such as, you know, components of wind turbines, components of solar panels, etc. But they're more focused on that than they used to be. And there's, I attended a webinar recently where they were focusing on this topic, and something like $30 trillion of LP money has gone into sustainable/impact investing in the last couple of years. $10.5 billion has gone to 300 ESG funds in the US alone in Q1. So it's happening. And so the question and challenge for mining PE is, you know, how do you position yourselves rather than just pay lip service to it? You know, it's not just building a local school and a village water pump. It's more than that.
I think now, as you said, Verne, it's a prerequisite to even get through the door, to make sure that you're ESG compliant, that you're, you know, that you have full cognizance of a need to decarbonize, etc. So, but in my mind, LPs still have, well, because a lot of the funds which are going into ESG and into various technology, they actually, a lot of them are oil and gas related, and LP community is yet to wake up to decarbonization of the mining industry and ESG of the mining industry. A lot of the focus so far and funds available so far related to oil and gas and renewables, etc. So for mining is yet to come. There are plenty. That Vale had a very interesting presentation. It's available publicly, and they have a whole page on them considering multiple technologies to, you know, clean up the entire value chain, from obviously from safety of the operations to autonomous workings to ESG, but also decarbonization type of technologies in iron ore processing. So yeah. I think it's going to still LPs need to a lot of education to wake up for that, because most of it is the education has been done towards the oil and gas sector.
Mm-hmm. Yeah, but there are also interesting geopolitical elements here. You know, where China produces and consumes over 90% of rare earths, of the relevant economically viable rare earths, magnet metals, etc. And the environmental impact of those productions are receiving increasing attention from Chinese authorities, as they should. But it's interesting how in the US in particular, they're beginning to look to try and become somewhat self-sufficient, having run down their rare earth stockpiles dramatically. As you know, US-China tensions develop. But an interesting thing will be with this impact, this focus of $30 trillion on impact investing and ESG in mining in due course will get its focus as well from these investors, is if you need a certain type of rare earth and it can only be produced in pretty bad environmentally impacting ways, what do you do? Is there such a thing as blood diamonds in metals? Where investors want to shy away from them.
Well, I guess we saw this week, didn't we, that the Norwegian their big oil and gas fund have now pulled out of a lot of the majors. So I think Glencore, Anglo, because of the coal-related thresholds weren't being hit. So maybe we'll see some more of that type of action.
Yeah, I mean they're out of the big oil and gas stocks. Largest cap US listed oil major has a market cap below where it was a quarter of a century ago.
It will filter down. Sorry, it will filter down. Sorry, it will filter down definitely from the big companies who are already seeing a lot of scrutiny on these types of issues. But I think importantly for us, we need to make sure that the companies that we're investing in, we're advancing projects and that they are attractive from an ESG and footprint point of view, because ultimately, one of the exits that maybe we're looking to down the road is that the asset might be bought by a bigger company, and those assets are so important now for the big companies that it's crucial that you've done the right ESG environmental work and studies, etc.
Yeah, that was one of the questions for the corporates who are listening and looking, or already have and looking to supplement their investments from private equity investors. From now is that ESG slide got to be the first one in their deck? Have they got to be able to convince you pretty quickly that they're going to meet certain standards? What do you look for in those types of corporates?
Well, I think
it.
Go ahead, Dave.
Go ahead.
Well, yeah. I think it's not necessarily first slide. I believe it just now assumed it's all in order. So it's one of those prerequisites. You have to have it to get present to us. So it goes without saying. So I think and then the fundamentals of the asset, addressable market, the position on the cash cost curve still remains, of course, the number one factor to choose from. Again, compliance with ESG is for us is becoming a given, right? And then so we don't even. It's not going to be. It's a tick, and we need. It's not a tick. It's more than that, but they have to have it to even come to us.
What would be your kind of typical ESG? What would really pull you in for a company? So we've talked about CSR and building schools, hospitals, etc. But most of the juniors and the mid caps are kind of doing that already. What more do they have to do to step up the mark? Is it about decarbonisation? Is it about having solar on site? What really gets you excited on the ESG ticking the box?
Well, for instance, I get quite excited, if you like, about appropriate waste disposal, and that's on everyone's forefront, sort of thinking, making sure that the tailings are not pumped in the middle of nowhere, but they, dry stacked according, to all the best industry standards. So rehabilitation, that I think is quite fundamental. And yes, it's more expensive, but I think as David said, then you try to exit this asset. That's something that, the tailings disposal, for instance, is going to be something that any mining company will look at very carefully.
Yeah, it's got to be best practice. You line the dam. You don't just not line it. You pay the extra to potentially gold plate whatever you're doing in terms of remediation and impact on the local environment and water sources and the like. But most of the PE firms now subscribe to the UN PRI, as well as the World Bank IFC criteria. They sign up to that, and they are audited on that, which is good, certainly at the UN. And those set out basic principles, which are kind of logical, but if you sign up to them and you're audited and you have to produce a half-inch thick report every year to a UN body, it focuses the mind.
So
it's good for business. If you're in some Central African country, you want to make sure that you're good for the local community and that you're producing tax for the country and that you're a good corporate citizen. It's not like some major new discovery ESG.
Yeah, it's just been rebranded. It's more important. Yeah.
Some years ago, Anglo-American was viewed as gold plating everything, and then a new management came into Anglo-American to try and cut costs and improve margins, and that led to maybe some slippage. And people used to say, "Oh, Anglo, they always gold plate stuff unnecessarily." In fact, probably they were doing the right thing.
Yeah. Okay, I was going to move on a little bit from ESG and just move on to the financing side, and just to see whether the types of structures of financing that you're looking at have changed at all because of the situation we're in, or whether it's a mixture of equity. I don't know how if any of you have debt funds, or if you're looking at royalties or alternative streaming arrangements. Is there any particular favor at the moment, or is it very much asset dependent?
It is asset dependent, really, but I think we're largely, as before, we're strategic equity investors, public and private companies. We quite like convertible notes. We may look at other types of structures, maybe at an asset level, but it's the same type of equity approach. We don't have a debt sort of straight senior debt fund, so it's much more on the equity side.
Yeah, I think we are very similar strategy, and we work across very similar spectrum as David's firm. I personally quite like convertible debt because you sort of have both of best of both worlds. We don't do pure debt. I think royalties will become a more frequent way of getting our return, and especially when you look at exits, and if the exits are staged, and so that can be all incorporated at sort of a back end of the life cycle of investment. So we definitely would look at royalty now, but overall, the private equity fund.
Yeah, I mean, there are quite a number of mining finance firms now, Orion, Taurus, etc., RK, and certainly the large listed royalty companies trade at significant premiums to mining companies. It's clearly an attractive investment for investors to get good royalties and streaming. And interestingly, on the debt side, Sprott have recently closed an $850 million Sprott mining lending fund 2. I think they targeted $1 billion, but they closed it at what, 850. And in that they brought in, for the first time ever, a well-known West Coast LP who'd never done any mining type commitment, with a couple $100 million of commitment there. And then Sprott have also launched a royalty and streaming fund, perhaps $400-500 million, which was cornerstoned by another well-known high-profile but never investing in mining before West Coast institution. So there's plenty of firepower now for credit and royalty and streaming for mining juniors, although typically the target is a listed entity rather than a private entity.
Yeah, I noticed was it Franco-Nevada have put 100 million into Sol Gold this week. I'm assuming that's by way of a royalty.
Mm-hmm.
I guess the flip side of credit funds is that this is quite expensive funding.
Yeah.
And again, there is competition, as we discussed. Good assets are, rare, and for these good assets, these credit funds will be competing with your BNP Paribas, SocGens, type of institutions who will lend at much lower margins. So you see, so these new credit funds, they will have to join the race. Let's put it this way, for the margin.
Yeah.
Yeah, I agree with that. I think that's right.
What do you? I guess the one-to-one, certainly, as there normally is every year, there'll be a lot of juniors out there. Some will be greenfield, some will be in development. How do you see the kind of post-COVID landscape for the juniors? Is it going to continue to be a very difficult time for them to raise capital, or do you think now is actually not a bad time to be entering the race?
Well, interestingly, the equity markets are relatively open for juniors at the moment. You see Hannam Partners just raised 40 million in a placing for that phosphates company, Crops. And there have been other placings in the last month or two in the gold and junior areas. So they seem to be having not a bad time in the sun at the moment. How long that continues, we'll see. But the juniors still trundle on. I suspect a handful will go to the wall in the next 3 to 6 months, because there have been a number of listed juniors that just aren't long-term viable. That probably will happen, or they'll be absorbed in other companies that are using this opportunity to expand a bit.
Certainly quite a bit of interest in gold, isn't there, at the moment? And you're seeing a number of gold juniors raising money. There's been a few small royalty companies have IPO'd in the last little while here. And certainly there's a lot of activity on the gold side. And as Verne said, you're starting to see some investors who've not been traditional investors in mining. They're looking at gold particularly, I think, at the moment.
Yeah. Now, I've heard of a number of Canadian specialist funds and some generalists that have been, casting bread on the gold waters and buying bits and pieces of a range of different mining juniors, particularly gold, specifically gold, in fact. And I don't know how much that's driven by BAML talking about a $3,000 gold price in the next 18 months, but that got attention, that's for sure.
Yeah, certainly a lot of the juniors attending the one-to-one, I know, are gold based, and from our own experience, we're seeing a lot of activity in the M&A space around gold as well. So you could imagine with two companies coming together, they need more funds. There's going to be likely more fundraising in that space.
Definitely gold, but I think times will be tougher for, you know, smaller niche commodities, graphites, you know, tungsten, vanadium. Well, vanadium maybe not. I mean, but so I think if you're in gold sector, you probably, chances are you'll raise if you have a half decent asset. But I think smaller, more niche, noble metals, they might struggle, and that's so just because a lot of investors are distracted by gold now. That's number one. Yes, but I think generally, I can't see junior sector disappearing. They just will adapt like everybody else, and the budgets will get stretched to the unimaginable length. So which we're already seeing. It's possible. So which is actually positive. You know, cost control and discipline is something we welcome at all times. So yeah, watch that space.
And is for the juniors who are not listed companies yet, I know what you're going to say to this one, but is your advice still that companies should prefer private capital over public markets?
Well, sometimes you don't have a choice, you know. I mean, there's such a thing as a London mining-focused junior stockbroking firm. You know, they're in the business of doing public raises for the mining juniors, and it's not that easy to persuade these hard-nosed private equity investors who are have lots of skin in the game and co-invest commitments themselves to easily cut a check. So you know, fortunately, despite MiFID II and all that, the London stockbroking community that supports and researches and raises capital for the juniors is still around. And along with them, you know, their fellow travelers, such as the corporate law firms and so on, who actually put the whole thing together.
Yeah. Yeah.
I think a big mistake.
Interestingly, an example of this this sort of plant, you know, pond life, if you like, that keeps reinventing itself is that Stiefel, for example, who were not in the mining sector at all and were very big in the oil and gas sector in terms of equity research, corporate broking, and fundraising, you know, have now gone back into mining and are very actively putting out mining equity research anew.
Yeah. Yeah.
Yeah, public to private sort of dilemma, which a lot of the juniors are facing. I always felt that junior miners often go to the market, the public markets, too early.
Yeah,
and exactly, and the big funding comes toward the end, and they need anchor investors. And so what you often see is they go green shoots, they go list, then they can't attract private equity money, can't attract you know, proper development money to advance them to the pre-construction phase, delist, you know, and list again and get sold. So it's you know, it's a very typical sort of trend that we see. So in my mind, sure, listing is a fantastic option, but do it in the right time.
Yeah.
Well, I mean, as private equity groups, will you look at taking 100% of a company private and putting it under your own wing and developing it and then IPOing it at a later date, for example? Is that a business model that attracts you?
Yeah, we've done it several times. At the right price.
Yeah. That may be some comfort to those watching. Yeah.
Yeah. Yeah, we'll invest in both public and private companies, Charles. And, you know, we've had a few of our companies over the period who have at different points who've IPO'd because it was the right time for them to do that.
Yeah.
You know, and I think we don't have one at the moment. But if we were invested in a private gold company and we'd advanced it to a certain stage, you might think about listing it now, for example.
Yes.
Mm-hmm.
Okay, well, I guess we should probably just about wrap it up. I guess any final comments for where you see the market in 6 months' time? Are we all going to be still gold bugs, or will you have turned your attention to something else?
I'm really hoping for V-shaped recovery. Definitely.
Certainly, I would be positive on precious metals, and in 12 months' time, I'd be positive on most metals actually across the board, particularly copper.
Yeah, I'd agree with that. Precious metals are going to have a good 6 months, and then after that, copper, nickel, etc., I think will come back into focus.
Perfect. Well, thanks everyone for your experience and advice. For those watching, it's very grateful. And have a good time at the conference if you're seeing people over the next few days.
Great, thank you. Thank you, Adam. Thank you, Charles.
Thank you both.
Thanks very much, Charles.